Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager of trading and derivatives education here at Schwab, and this is Trading a Smaller Account. Today, I think what we're going to do is focus on that trader who's a little bit more aggressive. Maybe they're looking to search for and trade stocks using a mechanical approach to trading, or in other words, a non-discretionary approach. So that's what we're going to be doing. We're going to be using the Thinkorswim stock scanner to scan for mechanical trades that are a little bit more aggressive. I think this should be an interesting discussion. We'll talk about what we're going to be looking for, how we're going to do it. We'll place a trade before we're done. A lot to cover before we get to any of that, though. Let me first of all say hello to everybody who's chatting in out there in YouTube. Hello there. Even though I'm here just filling in, I recognize the vast majority of those that are already chatting in. Great to see Paul and Kelly, Jay Richardson, Josh. Hello, Selva and David and Sia, and who else is here? We have Option 66 and Dom and Ricebird, Susie, everybody else. Thanks for joining us week after week and session after session. We always do appreciate your attendance and your contributions to these discussions. If you're here in this webcast for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, watching those recordings is a great way to watch these webcasts. But if you'd like to be here in this series, in this discussion, during the live presentation, well, this is a Friday webcast series, and we kick things off promptly here at noon Eastern Standard Time. Or just Eastern Time. Would love to have you here in our live stream audience. As a special treat for my live stream audience members right now, we have Scott Thompson who's going to be hanging out in the chats with us. Scott's going to be keeping an eye on those chats, and if there's a question that comes in that I can't get to, Scott's going to help me pick up the slack there. Scott and I have worked together now for 2 decades, which is always wild to say, but Scott brings a ton of experience to this. Thanks for being there, Scott. Now, I'd also like to issue an invitation to everybody listening or watching to follow me on social media. You can find me on X at Cameron May CS. You can also now find me on LinkedIn if you go to linkedin.com/in and then throw the /Cameron May CS. That's where you'll find my profile. You can give me a follow there. All right, but let's get into this discussion. And of course, as we embark on this journey, it's going to involve risk. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so today's focus is all about using the Thinkorswim Stock Hacker to scan for really non-discretionary trade signals for more aggressive stock trades. So what we're going to do first is take a quick peek at what's going on with the S&P 500 to get a gauge for the sort of context that a trader might be trading in right now. Then we'll talk through a hypothetical trader's list of priorities as they're planning to place a relatively short-term trade. What might they be looking for from the stock? What might they be looking for on the chart? And then we're going to go construct a scan to find stocks that meet those criteria. Ultimately, we're going to wind up planning and placing an example relatively aggressive, that meaning relatively short-term stock trade built on non-discretionary or mechanical trade signals. All right, I think this is going to be good. So let's go right to it. Let's go to the Thinkorswim desktop platform. Here's the S&P 500. It's the day after Thanksgiving. We're moving into the Christmas season, and so far, so good. Everybody's in a good festive holiday spirit, apparently. Trading just below that record close right there. We're less than 1% below that close. So it's been very bullish market conditions for a pretty extended period. Yes, there's been some choppiness here that may actually be appealing to someone who's looking for a quicker turnaround sort of a trade scenario. But there's also something else that I saw that might be intriguing to some technicians, and that is, let's add a simple moving average, which is commonly used as trend line, also sometimes used as support and resistance. I'm going to add a simple moving average to our chart, and let's go out to an intermediate to long-term time frame. How about a length of 100 days? So let's apply that to our chart. Click OK, click apply, click OK again. And so if you're not familiar with a simple moving average, it looks over the last however many days. We selected 100, and it figures out the average closing value of your stock or your index for that time frame. So right now, the average closing value over the last 100 days on the S&P 500 has been about 65.69. And right now, the S&P is at 68.42, so we're trading above average, which might be a confirmation of a continuation of an intermediate to longer term trend. So I think that's interesting, but also you'll notice these recent sell-offs took us right down. This is the second potential application of this moving average. We came down and those average prices acted as a pretty good price floor. It's not uncommon for traders to be looking to get in. They might think that in a short term, maybe things are overpriced. If I could just get in at an average level, that might contribute to this sort of behavior. Now, we don't always know exactly why prices choose to find the price floors they do, but in this case, kind of interesting that we bumped against those lows. So in any case, let's say that our trader has been looking at price action. They've been looking at a technical indicator. Maybe they just conclude that it looks like kind of bullish conditions. So today we're going to be planning and placing just a long stock position. Now, before we move on to doing a search for stocks, I want to give some additional context here. And that is, I mentioned earlier, we're moving through the holiday season. I know a lot of you can answer this question right now. Over the last 20 years, what has been the tendency of the S&P 500 during the holidays? Has it been more bullish? Has it been more bearish? Has it been neutral? What do you think? And if we didn't know that context, how could we quickly gain that context? Well, here's a quick way to do that. As you're chatting in your answers, we can go up to our chart style, and we're going to change this from a standard candlestick chart to what's known as a seasonality chart. You've seen me use this quite a bit in the past, but let's do it one more time. I'm going to go to seasonality. And when we first load that, it brings up this year's performance of the S&P 500 or whatever symbol we're charting right now. So in this case, it's the SPX. And we know what the S&P has done. It hit lows in April. It's been rallying right up till now in late November. It also loads by default how that index or whatever we have charted, in this case, it's the S&P index, how it did last year. So we could do sort of maybe season by season comparisons of, is there a tendency developing here, a seasonality tendency? What did it do last year, for example, through the holidays? Looks like it was fairly bullish. What's it doing right now through the holidays? Well, it looks like we're getting off to a pretty good start. But what has been a longer term tendency? This is where we could change that seasonality tool. Let's just come up here and change the time frame out to a 20-year chart. And now we're still seeing this year, but now at the bottom, we're seeing the average performance over a 20-year or a 1 month period. Okay, let me restate that. We're seeing the average performance of any given 12-month period over the last 20 years. That's what this red line is down at the bottom, but it is kind of compressed. So we need to zoom in on that so it was a little bit more meaningful. So here's your zoom function. Come up here, select manual. That allows us to come down and manually zoom in on that line. There we go. Now this shows us kind of seasonal tendencies over the last 20 years. So it's not a fully maximized data set. We have to realize the constraints of what we're looking at here. But over the last 20 years, starting about the first part of October, the markets have gotten bullish and stayed bullish on average. And if we look at where we are right now, today's November 28th, well, from the average November 28th till the end of the average year over the last 20 years, there has been appreciation of the S&P 500 on the order of about 1.5%. Now, that might not sound like a lot, but that's a pretty solid performance. There are other times of the year when there is a negative net performance or just not much accomplished, even stretching out over months. So that might be important context for some traders. Let's just say that our trader has looked at what's going on with current S&P 500 behavior. They've looked at what's happened historically, and they're just feeling a little bit better about being more bullish. None of that adds up to guarantee, but those are going to be our assumptions. So let's switch our chart style back to just a standard chart, and let's plan and place a short-term, relatively aggressive trade using what are called mechanical or non-discretionary trade signals, right? And I'm going to lean on what the indicator that we already have right here. So our 100 period moving average for some is an identifier of an intermediate to longer term trend. And an interpretation of bullish versus bearish might be, well, as long as price is above that that longer term trend, maybe that's still a bullish stock behaving bullishly. All right, let me thicken up this line. I'm going to come up here because I'm going to be ultimately adding another moving average to the chart. So let's change this line. Let's make it a thickness of 3 out of 5 rather than just 1 out of 5. And now I'm going to switch over to a stock that I have pre-selected as today's trade, and I'll show you. I'm going to talk through why it was selected. I'm going to talk through how I found it, and then I'm going to talk through why we're buying it today and when we might sell it. All right, so here's Lyft, a company that a lot of you are familiar with. First thing we might notice as we look at a chart of Lyft, this is a 1-year chart, we might notice that its 100 period moving average, despite significant volatility over the last couple of months, is still net trending higher. So what might the technical trader think about the longer term trend? Still appears to be up. That's just looking at it through one technical lens. But for some traders, they want to qualify whether we're net bullish or bearish. And this is one way that some traders might do that. Now, a second fact that we can observe right away is that price is above that 100 period moving average. If a trend is up, but price is below that trend, for some, they see that as an early emergence of technical shift in the scenario. Okay. Ricebird says, the question in my mind is, will we have a Santa rally? So Ricebird is looking toward the end of the year where there seems to be a historical tendency for additional bullishness. Will 2025 transition to 2026 carry that? Possibly. The odds seem to lean that way, but each year is an independent event unto itself. Time will tell. Good question. All right, but that's what a Santa rally is. It's basically the last few trading days of the year into the first few trading days of the next year. Some people extend it through the whole holiday season. That's a different version of the Santa rally, but we'll see. And Jay Richardson is pointing over the horizon 2 weeks out to the FOMC meeting and Fed rate announcement on December 10th. We'll see if that could come in and throw a kink into the works, couldn't it? Yeah, could. We'll see. All right, but let me talk about some priorities for our would-be short-term, let's say more aggressive trader. What might they be looking for in a company like Lyft? Why was Lyft chosen? And what might they want to see on the chart? And then how can we build a scan for that? So I came up with a list of hypothetical priorities. It's not intended to be an exhaustive list. It's a representative list of what some shorter term traders might be looking for. First of all, size of the company. Some of them might recognize Lyft is not Amazon. Lyft is not Tesla. It's not one of the Wall Street giants. Instead, for some shorter term traders, they have a preference for looking for stocks that haven't entirely enjoyed the full blast of the market limelight. Maybe they see more opportunity for growth as a result. So maybe instead of looking for large capitalization companies, maybe they're looking in the mid to small capitalization range, looking at those smaller companies that might carry more potential. Now, potential goes unrealized all the time. Got to say that. But let's say that our priority number one is, for our hypothetical trader, looking for kind of smaller companies. Now, some of those smaller companies may still not fit inside the realities of a smaller account. There are plenty of small companies out there trading in the triple digits and above. And for this webcast series, we typically try to, we operate within some constraints, recognizing this is called trading a smaller account. We've defined just sort of at a random breakpoint, smaller being $20,000 or less, just for the examples of this series discussion. As a result of that relatively small portfolio, we take relatively small positions, $5,000 or less. So if the trader is managing a smaller portfolio, sometimes they're looking for, let's say, lower prices on those stocks. So smaller companies at lower prices, obviously hoping they become higher priced companies of larger sizes subsequently. All right. But Priority number one, smaller companies. Priority number two, a lower price. Now, with that lower price may come priority number three. Lower price companies can tend to be quite volatile. If it's helpful, let's kind of map these out. Let's come over here. Let's load up our scratch pad. We open up some space. These are just example priorities. Let's see. Number one, smaller, not Samler, smaller companies. Number two, lower prices. Number three, greater volatility. Isn't volatility bad? Why would I say volatility? Actually, volatility is neither inherently good nor inherently bad. Instead, what some traders who are trying to build a smaller portfolio are looking for is more rapid opportunity. Sometimes opportunity turns into failure more rapidly. That could certainly happen. But greater volatility, a stock that moves, may be more attractive to a trader who's trying to give themselves opportunity for shorter term gains than a stock that's done nothing over the last month, the last year. If a stock hasn't been doing anything, it seems more likely that it's going to do much while we're waiting around for it to do something. So greater volatility might be a third priority. Number four, we're going to shift our attention to the stock chart. And for a trader, let's just stick with the bullish side of things, since we see S&P has been quite bullish, still above its 100 period moving average. Let's say that our trader is looking for bullish trends on their stock that they select. And then finally, within that trend, even with a great trend, even on a stock that seems small, lower priced, greater volatility, possibly offering more potential upside, there can be better and worse times to trade. You look at Lyft right here. Buying here would have been terrible for at least a few months. Buying here would have been not a fun ride for at least about 2 months here. There are less optimal times, and then there are potentially, conceptually, more optimal times. So a recent entry signal might be a final priority. So what we're attempting to define here for this trade scenario is exactly what we're looking for. And now I want to know exactly how to go find that. So those are our priorities. How do we put those priorities into a language that Thinkorswim can understand to go find a stocks that will meet those priorities? Let's go do that. I'm going to go to the Stock Hacker, and let's look for companies exhibiting each of these priorities right up to this moment. All right. So I'm going to start with just a blank Stock Hacker scan. First, let's address this one. Smaller companies. How do we define smaller companies? Well, market capitalization is the way that we traditionally define small, medium, and large. And so that's actually one of the defaults here in this menu. Let's choose market cap. And what is the definition of small cap? Sia says, Cameron, did you pull this rabbit from a scanner based on these data points? Exactly, I did. Yeah, Sia. Now, if the universe is being kind to me today, Lyft will still be a qualified company that will show up in the search results here. It's possible it won't be. If the stock price falls enough, it may slip off this scan's radar. Anyway, what is the definition of a small cap company? Well, you've probably heard of small cap, mid cap, large cap. Generally speaking, and opinions on exactly these numbers can vary, but a small capitalization company is typically seen as a company valued between $300 million and $2 billion, taking price of the stock multiplied by number of shares. So if we have $100 stock and there are 1 million shares, that's a $100 million company. That would actually be in the micro cap category. So starting at a minimum threshold about 300 million, a company qualifies by that definition to be called small cap, as long as it doesn't go above $2 billion in total market cap. Between $2 and $10 billion is our mid cap range. And then $10 billion and above, we're pushing up into the large cap. Let's say that our trader here is kind of steering clear of the large cap. Maybe they think those companies are settling out of a more expansive growth phase in their life cycle. Now, big companies can actually grow very rapidly. We've all seen it before. But let's say that for the examples of this discussion, let's set our minimum at the lowest range of small cap, that's 300 million. And let's put the top end at 10,000 million, or in other words, that would be 10 billion. And as we move on to our next criteria, you can see about 4,400 companies fall in that small to mid cap range. 10 billion might not sound like a very small company, but in Wall Street terms, that ain't so big. That's still, I think that there are plenty of traders who might agree that we could call that a smaller company, even if it's not truly small cap. All right, our next criteria was lower prices. What's the definition of lower? Well, that can vary, but let's say for the purposes of this trader managing this smaller portfolio of $20,000 where they don't spend more than $5, well, let's say that occasionally our trader likes to do options. And so if they are buying companies that are priced above $50 per share, they can't even buy 100 shares and keep under the $5,000 cap. So let's set our maximum here at $50. Now on the low end, let's say that our trader also recognizes you can run into liquidity issues if our stock is really low in value. That's when we're starting to get closer to what we call penny stock territory. And how about our trader just has a preference to maybe not go below $20? There are plenty of traders that like to trade in the very low end of the scale here. But let's just set this as our price scale. $20 on the low end, maybe to keep away from those really volatile penny stock, not even optionable in a lot of cases. Even if they are optionable, probably illiquid options. And let's dial that up to maybe $50. So I don't know, maybe a trader can buy at least 100 shares, maybe sell covered calls on it down the road, something like that. Okay. Oh, thank you, Josh. Yeah, I've done this before. I've been guilty of this. Josh just pointed out I didn't change my filter. Right now I'm scanning for stocks that have 20 to 50 shares. Let's change that to, let's put in the last price. There we go. So the last price, 20 to 50. Thank you, Josh. Appreciate it. Yep. Sometimes I move on. I'm talking, I'm typing, and I miss a step. So if you ever catch me doing that, I'm a grown man who can take the embarrassment, so let me know. It's way more important that we get it right than to preserve my fragile ego. All right. So next up, we have a measure of volatility. How do stock traders measure volatility? There are a number of ways to do that. Possibly the most common way is to use a metric known as beta. Beta just benchmarks our stock against the S&P 500. So how volatile is the S&P 500 and how volatile is the stock? That's the question being addressed by beta. So if the S&P goes up 1% and our stock on average also goes up 1%, or if the S&P goes down 1% and our stock on average goes down 1% in the same direction, about the same amount, we would say, ooh, that seems to be highly correlated to the S&P 500. 1-to-1 price relationship. So that would have a beta value of 1. Right? That's so if we to me that's very intuitive. If a stock has a 1-to-1 relationship, its volatility metric should just be 1. Now, if a stock is moving in the same direction as the S&P 500 on average, but it moves further, it will have a higher than 1 beta. So let's say it goes 20% faster than the S&P 500. That would have a beta of 1.2. If it's 20% slower, it would have a beta of 0.8. Importantly, it would be a positive beta because the two are generally moving in the same direction. It's just that our stock moves a little bit faster in that direction. When going up, it goes up faster. When going down, it goes down faster, but generally in the same direction. That's the positive beta, positive correlation. Yes, it is possible to have a negative beta. If the S&P goes up and our stock tends to go down, the S&P goes down, our stock tends to go up, it would typically have a negative beta, right? But let's say for our trader, minimum 1, that doesn't sound very volatile. Let's say that we want the stocks to have at least 20% more volatility on average than the S&P 500. Now, volatility can deliver greater potential, can also deliver greater risk. So let's put a cap on this. Let's say that our trader wants more volatility, but let's not get too wild. Put a cap at 2.5. That would be 150% more volatility allowable than the S&P 500. But that's the cap here. Not everybody agrees with that, but that's where we're setting it today. So that's it for our stock criteria. But now we were talking about moving averages. I'm going to add two here conceptually. First one is going to be that 100 period simple moving average. Let's add that as a study filter. And I'm going to put in a custom requirement that our price is currently above the 100 period simple moving average. So here's how we might do that. If you didn't catch that, we come here to our study filter menu, we choose custom. Delete the ADX crossover as the default, just to start things. Then click add condition. And we're going to require that the price of the stock, let's say the closing price, is greater than a study, and the study is the simple moving average. We'll choose simple moving average. And which simple moving average? The 100. That's it. So we're saying right now we want the price to be, let me scroll it back up here a little bit. See what I'm doing here. The closing price is greater than the 100 period simple moving average as of right now within today's bar. Save that. Okay, click OK. Close is greater than the 100 simple moving average. Now, that's nice, but if we were to go to the chart again, this close was above the 100 period moving average. This close was above the 100 period moving average. Those are very different trading scenarios. So this brings in, this is our confirmation of the bullish trend. It's not a perfect confirmation, but it's one potential confirmation, the price being above the 100 period simple moving average. But also our trader might be looking for a more recent signal. This may not be considered to be a terribly recent signal. The stock has already run up dramatically. So to generate possibly more recent signals within confirmed upward trends, according to the 100 period moving average, a trader might use a shorter term moving average, a shorter term trend. For example, a price crossing above a 9 period moving average, not looking over the last 100 days, but just over the last 9 days. That's what we're going to require here. Let me show this on the chart. Let me edit my studies, and I'm going to bring up an exponential, a faster moving average. So we're going to choose the moving average exponential, add that to our chart. By default, that's going to be 9 days. It's not even 2 weeks of data. So I'm going to click on the little gear icon here and distinguish this line from the other line that we already have on our chart. Let's make this one red, but I'm going to leave this one a 1 out of 5 in thickness. So it's going to be the thinner red line. Let's click OK, click apply, click OK again. And so here's the purpose of this filter. When price has been coming down in the short term, that will tend to drag down this very short-term trend line. If price starts to rally, it makes it easier for price to go through that trend line, even while still being above the longer term. So for our trader looking for a mechanical signal, price crossing above a short-term moving average is mechanical. There's no discretion needed for that. It either is above or it is not above that moving average. The other thing that it can do is create a very fast signal. So it's an aggressive, non-discretionary trading approach. Now, notice nowhere in that did I say guaranteed profitable. No, this trade may work or it may not. But let's say this suits all of our traders' criteria. It's a smaller company with a lower price. This one's, as a matter of fact, only $20 per share. Greater volatility because we required a beta of more than 1.2. Is there a bullish trend? There appears to be. We have an upward sloping 100 period moving average and price is above that. And is there a recent signal? Looks like price has just now crossed above a very short-term trend line. All right. Jay Richardson says, why exactly 9? That seems kind of random, doesn't it, Jay Richardson? Well, for some traders, they may use an even shorter term moving average, into like a 5. If you start to get really short, the moving average just tends to stick right with price and you get signals all the time. If you go longer, 15, 20, it slows the signals down for better or for worse. It creates later signals in, later signals out. Sometimes that's a good thing, sometimes that's a bad thing. So for some traders trying to find that balance, going in that maybe 9 to 10 day range, maybe what they choose. For traders who are real sticklers for like average time lengths, you'll notice they'll tend to use weird numbers, like they'll use 21 or they'll use 9. 21 because there's typically 21 days in a full month of trading. Well, if we're just looking at 2 weeks, that sounds like half a month. We know that's not exactly half a month. It's a little bit less than half a month. And accounting for occasional holidays, such as the one that we had this week, a typical week might only have somewhere around 9 or 9.5 days of trading, typical 2-week cycle. That is the logic of using 9 days. It's a typical 2-week cycle. Does that make sense? All right. So yeah, it's just intended to follow up 2 weeks, down 2 weeks, that sort of a thing. All right. So here we have this relatively fresh signal. How do we put that into our scan? Let's go back to our scan. We have our other requirements here. We're going to add one more filter. Let's go up here and add a filter. As a matter of fact, we can actually do it over here. Let's do this. Let's go study. Here, let's use a crossover of price. So this is just a default study. Go to crossovers, choose price average crossover. So it's price crossing over a moving average. And let's just say we want our closing price to cross above an exponential moving average of 9 days. Why exponential versus simple? It's a little bit faster. Exponential moving averages put a greater weight on what's happened more recently than on what happened, let's say, 9 days ago. So it just speeds up the signal just a little bit more. And for someone looking to be a little bit more aggressive, it accomplishes that objective in most cases. Now, aggressive doesn't always mean more profitable. It means more aggressive. There we go. So let's put that in there. And that is our scan. 300 million to $10 billion companies, priced between $20 and $50 per share. As a matter of fact, let me just close this left column. With a beta or a volatility that's from somewhere 20% above average to 150% above average, with a bullish trend and a recent technical, non-discretionary mechanical signal. That's quite the scan. Now, what we could do, since we've created this, we could come up here and save this scan. What I will also do, let me share this scan. Let me share that. Let me paste it here in the chat window for the live attendees. I'll make a quick note that shared scans are not guaranteed as to accuracy or timing. I'm also going to add this scan over here to my notes, so I remember to paste it into my video description. So those are now my session notes. So for those of you watching on the recording, you just go down in the video description, click on that, and I'll have a link in there. And so if you want to load this scan, you can just load it up and run it yourself. Okay. So now let's run this scan, and I want to see. I'm expecting lift. If lift doesn't show up here, I'm going to throw my hands up and have a bit. Anyway, I'm looking at this. Sometimes this can happen when I'm running a webcast. It could put quite a bandwidth demand on my system and slow things down. I'm going to let that continue to work, but I'll tell you, probably going to wind up seeing about 10 stocks. I ran this earlier. So let me go show you the outcome of this scan. This also allowed me to find a company like PAY. What's going on with Paymentus Holdings? Well, it's a stock that you can see it swings up and down fairly dramatically. You can see that sometimes price crosses above that 9 period. Sometimes it crosses down through that 9 period exponential moving average. So what our trader might be looking for is for price to be above the 100, the longer term, with price itself crossing very recently, crossing and closing above that shorter term moving average. Jay Richardson ran the search at home and says, yep, lift is there. Let me see if my scan decided to cooperate. Now, sometimes it'll do that to me when I'm running a live webcast. That's fine. I don't mind. That's why I do these things before, so I'm prepared. But there you go. I've shared that scan. But I think what we're going to do today is let's trade lift. So if this is the entry, what is the exit? Well, we're going to use a mechanical exit as well, a non-discretionary exit. The exit is just going to be if price slips back down below that 9-day moving average, trade is over. So, and I mean slip below and close. Let's be precise. Close is below that moving average. So as an example, if I go back to a signal here, looks like we got down below the moving average and it closed. Actually, there was one right there where we got below the moving average and then rose back up and closed above that. That would have been a signal. And since then, when did we close after that below? Did we close here? Let's see. Moving average on that day was 2183. Close was 2182. Yep, that would have been an exit right there. Entry here, exit there. Now through here, this is a good example of how no system is perfect. What would this approach have likely done during this time frame? Well, there was a signal entry right here. There was a signal to exit right there. That would have been a marginally unprofitable entry and exit. That's what we call a whipsaw event. Here's another entry signal here, an immediate exit there, another small loss. So no system is perfect. Here, it gave an entry, closed above, and then closed below. That one was a little bit more profitable. So nothing's perfect. CSS pay has very low volume. Yeah, that's quite likely. For a stock trader, that might not be as much of an issue as, let's say, someone is moving on to do an option trade. Lift has a little heavier volume. So this is the one that we're going to trade. How many shares can we afford for $5,000? Looks like we can buy, let's just do a nice round lot of 200 shares. That'd be a little bit more than $4,000 at current prices. Let's go place our trade. I'm going to click on the ask price on the trade tab. Let's amend the quantity here. Let me widen this out so you can see this is 100 shares. We'll click the plus sign, make it 200 shares. And I'm going to put in an order to buy at the current market price. Market's closed today in 23 minutes. We're closing early for the holiday weekend. So let's make sure that we're giving this the best opportunity to get a quick fill. Obviously, when we submit a market order, there's a risk we might not like the price received. But I'm going to click confirm and send. Going to buy 200 shares of Lyft at the market price. No commission on this trade, but there can be on certain types of trades. And just remember the following order is expected to place the account. Oh, look at that, in a concentrated position. So that just has to do with I've spent all the cash in this. It doesn't matter. This is just an example trade. But when we see a little warning down here at the bottom, always take the time to read through that. Make sure that you know exactly what this is referring to. When in doubt, call the support line. But for this warning is telling me my order is probably not going to be able to fill because I don't have the money for it. I don't care because I didn't need to put this order actually through, but that's how the order is created. All right, so I'll just close that out, delete that. And with that, we've accomplished what I set out to do today. Now, remember, with this trade, in right now, waiting for price to, hopefully it just stays above the 9-period moving average for a nice little run, like it has on Pay, like it has on Lyft recently. Sometimes it won't, though. If it comes back down and closes below that 9 again, trade's over. There we go. Cola says, Cameron, can I apply your three green arrow scan methodology to this class? It's a little bit different. Those are two different approaches. If you don't know what Cola is referring to, I taught a webcast recently. Let me show you this because there are other resources. Since we've accomplished what I wanted to do today, I want to make sure that you're aware of all of the educational resources available to you from Schwab. But the first one of those that I want to highlight is the playlist for our previous webcast. So this is a great call out that 3 green arrows approach. That's a webcast I taught in my Advanced Charting Techniques webcast just a couple of weeks ago. So if you haven't done this already, make sure that you're subscribed to our Trader Talks channel on YouTube. You can just go down below the stream right now or below the video, click on subscribe. It only takes a second, doesn't cost anything. But our Trader Talks Schwab Coaching webcast channel is where you can join our live streams, but you can also look through our playlists of previous webcasts, and they're organized by series. So the series that I'm referring to is called Advanced Charting Techniques, right down here in the middle. I'm going to click on View Full Playlist, and then right here, 3 weeks ago, Building and Trading the 3 Green Arrows Method on a Stock Chart, if you want to see what Cole is asking about. Now, I also want you to know that you can follow your favorite Schwab presenters on social media. So you can follow me on X at Cameron May CS. Let me show you that. So here's my profile at Cameron May CS. If you want to look me up on X, give me a quick follow. But I'm on here frequently. I'll make posts. Like today, I threw out a reminder, hey, don't forget that the New York Stock Exchange and the NASDAQ will close early today at 1 o'clock Eastern, right? I also have other questions for you. Like, I don't know, it occurred to me, hey, what was the cheapest car you ever purchased? And would you buy that same car again? Because I think of mine, if you want to know, is a Mazda MPV, which is basically like a sport utility minivan. Love that car. Yeah, I think it cost me like $2,500. Anyway, what was your cheapest car? I like having these sorts of back and forth discussions on X, but you can also do this on LinkedIn. Let me pop over here to my LinkedIn profile. So to find me on LinkedIn, you go to linkedin.com/in and then throw on the /Cameron May CS. So it's the same username as I use on X, but there's my profile. You give me a follow there. And I also post here. If you reply to my posts on LinkedIn or on X, I just reply right back to you, and it opens up that discussion. All right, everybody. Oh, you like that open top British vintage? See ya? The yellow and red one? Yeah. All right. But guys, thanks for giving me your time today. Go enjoy your holiday weekend. I will be back on Monday. I'll look for you in that webcast. I'm going to look for you in my other webcasts. I'll also look to see you on social media, on X or on LinkedIn. But thanks for all the thumbs up as well, guys. I can see 150 people watching the live stream. And as I refresh my browser window here, 47 thumbs up already. Thank you. When you click that like button on YouTube, it sends a signal to your presenter. It says, nice job, good work. And I say, thank you. It also sends a signal to YouTube that says, hey, this guy's stuff is good. You ought to show it to other people. And so YouTube promotes it more. So it helps more people find these discussions, like how to do a scan for more aggressive, non-discretionary stock trade signals. All right. Everybody, thanks for giving me your time. I'll look for you in a future webcast. I'll look for you on social media. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye. Have a great weekend.